This question tests the definition of functional currency, a fundamental concept in foreign currency accounting under IAS 21, IFRS, and ASC 830, US GAAP. The functional currency is the currency that best reflects the economic substance of an entity's operations, rather than its legal location or reporting practices. Accounting standards define the functional currency as the currency of the primary economic environment in which the entity operates. It is typically the currency that primarily influences sales prices for goods and services, primarily influences labor, material, and other operating costs, represents the currency in which the entity generates and expends cash, often serves as the currency of financing and operating cash flows. The functional currency is determined by economic factors, not by the nationality of the parent company, the country where the entity is incorporated, or the currency used for bookkeeping. In multinational organizations, subsidiaries may have a functional currency different from both the parent's reporting currency and the local legal currency if another currency better reflects their economic environment. A. Of the entity's parent company. Incorrect. The parent company's currency is not automatically the subsidiary's functional currency. B. Of the primary country in which the entity is physically located. Incorrect. Geographic location alone does not determine functional currency. C. In which the books of record are maintained for all entity operations. Incorrect. The bookkeeping currency may differ from the functional currency. D. Of the primary economic environment in which the entity operates. Correct. This is the official accounting definition of functional currency under both IFRS and US GAAP. Correct answer, D. Of the primary economic environment in which the entity operates. Key takeaway: the functional currency is the currency of the primary economic environment in which an entity conducts its business. It is determined by the currency that most strongly influences sales, operating costs, and cash flows, rather than by the parent company's currency, physical location, or bookkeeping practices. This question tests the impact of the last in, first out, LIFO inventory costing method during inflationary periods. Under inflation, the cost of purchasing inventory rises over time, meaning the most recently acquired inventory has the highest cost. Under LIFO, the latest, most expensive inventory items are assumed to be sold first. Consequently, the cost of goods sold (COGS) reflects the most recent and higher purchase costs, while the ending inventory consists of older, lower-cost items remaining in stock. The accounting consequences during inflation are higher COGS because the newest and more expensive inventory is matched against current sales. Lower ending inventory value because inventory remaining on the balance sheet consists of older, cheaper units. Lower gross profit and taxable income compared with FIFO, which is one reason LIFO has historically been attractive in inflationary environments, where permitted. Students should contrast this with FIFO, which produces lower COGS and higher ending inventory values during inflation. A. Lower cost of goods sold and lower inventory value. Incorrect. LIFO produces higher, not lower, COGS during inflation. B. Lower cost of goods sold and higher inventory value. Incorrect. This describes the typical effect of FIFO, not LIFO. C. Higher cost of goods sold and higher inventory value. Incorrect. Although COGS is higher under LIFO, ending inventory is lower because older, lower-cost inventory remains on hand. D. Higher cost of goods sold and lower inventory value. Correct. LIFO assigns the most recent higher costs to COGS and leaves older lower-cost inventory in ending inventory. Correct answer, D. Higher cost of goods sold and lower inventory value. Key takeaway: during inflation, LIFO reports higher COGS and lower ending inventory values because the newest, highest-cost inventory is expensed first while older, lower-cost inventory remains on the balance sheet. This results in lower reported profits and lower inventory carrying values compared with FIFO. This question tests the accounting treatment for a change in accounting principle when the new method provides more reliable and relevant information. Under both IFRS, IAS 8, and US GAAP, ASC 250, voluntary changes in accounting principles are generally accounted for using the retrospective approach. Retrospective application means that the entity should restate prior period financial statements as if the new accounting principle had always been applied. Adjust the opening balance of retained earnings for the earliest comparative period presented to reflect the cumulative effect of the change. Provide appropriate disclosures explaining the nature and effect of the change. The purpose of retrospective application is to improve comparability between accounting periods. Although a change in depreciation method is often treated as a change in accounting estimate under IFRS and US GAAP, and applied prospectively, this question explicitly asks how a change in accounting principle should be reported. Therefore, The expected answer is the retrospective adjustment to beginning retained earnings. A. Disclose as a separate type of depreciation expense, directly following depreciation expense in the current year. Incorrect. Accounting principle changes are not reported as a separate depreciation expense item. B. Report as an adjustment to beginning retained earnings of the earliest period presented in the financial statements. Correct. A voluntary change in accounting principle is generally applied retrospectively, with a cumulative effect reflected in the opening retained earnings of the earliest comparative period. C. Include in the determination of profit or loss for the current period as a cumulative effect adjustment. Incorrect. Current standards no longer generally permit cumulative effect adjustments through current period income. D. Not disclose in the financial statements. Incorrect. Significant accounting changes require disclosure to users of the financial statements. Correct answer, B. Report as an adjustment to beginning retained earnings of the earliest period presented in the financial statements. Key takeaway: changes in accounting principles are generally reported retrospectively, requiring restatement of prior periods and an adjustment to the opening retained earnings of the earliest period presented, thereby enhancing the consistency and comparability of financial statements across reporting periods. This question tests the concept of economic profit, a fundamental idea in economics and managerial finance. Students should distinguish economic profit from accounting profit. Accounting profit is calculated as: explicit costs include actual cash expenses such as wages, rent, materials, utilities, and depreciation. Economic profit goes one step further by considering opportunity costs, implicit costs, in addition to explicit costs. Economic profit equals revenue-explicit costs-implicit costs. Implicit costs represent the value of resources owned by the business that could have been used elsewhere, such as the owner's time, invested capital, or foregone rental income. Because economic profit includes these opportunity costs, it is typically less than accounting profit. A business may report positive accounting profit but have zero or negative economic profit if its earnings are insufficient to compensate for the opportunity costs of invested resources. A. Revenue minus all accounting costs. Incorrect. This defines accounting profit, since accounting costs include only explicit costs. B. Income minus the sum of total fixed and variable costs. Incorrect. This ignores implicit opportunity costs and uses income rather than revenue. C. Revenue minus the sum of total fixed and variable costs. Incorrect. Fixed and variable costs represent explicit production costs but do not include implicit costs. D. Revenue minus all explicit and implicit costs. Correct. Economic profit deducts both explicit costs and implicit opportunity costs, providing a measure of true economic value creation. Correct answer, D. Revenue minus all explicit and implicit costs. Key takeaway: economic profit measures whether a business earns more than the total opportunity cost of its resources. It is calculated as revenue minus both explicit and implicit costs, making it a broader and more economically meaningful measure of performance than accounting profit.